An auditor is an independent professional who is appointed to review and assess the accuracy of a company's financial statements. The person who performs auditing and follows this process is called an auditor. The primary role of an auditor is to ensure that the company's financial report is free from material misstatements, aiming to check for no misstatements, errors, frauds, or false statements. The auditor verifies these statements while considering accounting principles, general accounting principles, laws, rules, regulations, and all statutory requirements. Types of auditors. Auditors can be categorized as either external or internal. External auditor, an independent person who is not related to the company. This is typically a professional person like a chartered accountant, CA. Internal auditor, any employee of the company or staff kept on a regular basis for specific auditing purposes and internal control of the company. Appointment of an auditor. The provisions regarding the appointment of an auditor are contained in Section 224 of the Companies Act. This section discusses different types of appointments. First auditor. Private companies. The board of directors appoints the first auditor within 30 days of incorporation. Incorporation means the day the business actually starts. If the board of directors fails to appoint the auditor within 30 days, the shareholders will appoint the first auditor within the next 90 days. Public companies. The criteria are almost the same as for private companies. The board of directors selects the first auditor within 30 days of incorporation, and if they fail, the shareholders will do so within 90 days. Subsequent auditor. This auditor is appointed every year by the shareholders in the annual general meeting after passing an ordinary resolution. An ordinary resolution means everyone normally agrees to select the person as the next auditor. Appointment by the central government. If no auditor is appointed in an annual general meeting, the central government may appoint the auditor to fill the vacancy. This is because the Companies Act makes it compulsory to appoint an external auditor. Appointment against a casual vacancy. If a casual vacancy of an auditor arises due to death, insanity, or insolvency, the board of directors can fill that vacancy by selecting another auditor in their place. This provision is written in Section 224, subsection 6 of the Companies Act. Casual vacancy means a situation where the appointed auditor is unable to perform auditing due to reasons like death, insanity, or their bank becoming corrupted. Appointment by special resolution. This is applicable under specific conditions as per Section 224A of the Companies Act 1974. Conditions for applicability. If 25% or more of the subscribed capital is held, either individually or collectively. If it is a public financial institution is related to finance, like a public bank. If it is a government company or any organization of the state government. If it is a financial institution in which the state government holds not less than 51% of the subscribed capital. If it is a nationalized bank, an insurance company, a general insurance company, or any other, like a life insurance company. Process. For special resolution, a document is prepared stating the appointment of a person as auditor. Votes are taken and everyone agrees to the appointment. After agreement, everyone signs the document. Subsequently, approval from the central government is required for the decision to be applicable. This process involves making a proper document, writing down all details, getting signatures, and then obtaining approval from the central government or relevant authority with a stamp of approval before the person can be appointed as auditor. Appointment of auditor in government companies. In government companies or companies where the majority of shareholders is owned by the government, meaning more than 51% of the share capital, the Controller and Auditor General of India, CAG, appoints the auditor. The CAG is the head of the Department of Government Auditing and Accounting Firms. The CAG appoints an auditor within 180 days of the commencement of the financial year. Qualities and qualifications of an auditor. An auditor should possess specific qualities and qualifications. These include professional qualifications. The auditor should be a chartered accountant, CA, and have passed the CA exam. They should have thorough knowledge of accounting, auditing, and all related subjects. Personal qualities. The auditor should possess honesty, be hardworking, and be sharp-minded. Rights of an auditor. Auditors have several rights under the Companies Act. Right to access books and records. The auditor has the right to access any financial statements and books of account of the company being audited. This includes the freedom to request and view trial balances, P&L accounts, balance sheets, and cash flow statements. Right to obtain information and explanation. If the auditor has doubts or needs clarification, they can ask anyone in the company for information and explanations, such as why something is recorded in a certain way or to see supporting vouchers. Right to visit branches. The auditor has the right to visit any branch of the company, inspect documents, and check any software. This is especially relevant for large companies with multiple branches. Right to receive notice and attend meetings. The auditor must be informed of important financial or accounting decisions and sent notices for meetings, such as annual general meetings, which they have the right to attend. Right to sign the audit report. The auditor has the right to sign the audit report they prepare, which may include different types of reports depending on the findings, e.g., if many mistakes are found. Right to report to the shareholders. The auditor can discuss the audited books of account and show the report to the shareholders. Right to seek legal and expert advice. If the auditor lacks knowledge on certain laws or legal acts, they can seek expert advice, such as from a lawyer, advocate, or judge. The company will bear the expenses for such advice. Right to remuneration. Audit fee. The auditor has the right to be paid an audit fee for the auditing work performed. This is a professional activity and the payment is considered a fee, not a salary, as the auditor is typically appointed at the end of the year. This audit fee is a cost or expense for the company. Duties of an auditor. An auditor has several responsibilities. Duty to conduct audit with due diligence. The auditor must perform auditing work with honesty and care. Duty to report on true and fair view. If any mistake, fraud, or misstatement is found, the auditor must report it immediately and not hide anything. Duty to detect fraud and error. This is a secondary objective of the auditor. Duty to follow auditing standards. The auditor must adhere to the separate auditing standards provided for auditing. Duty to maintain confidentiality. The auditor is responsible for maintaining the secrecy of the company's information. Duty to make qualified and clean report. The final report prepared by the auditor after auditing must be correct, clean, and free from any lies or misrepresentations. Duty to verify assets and liabilities. The auditor must properly verify all assets and liabilities stated in the company's balance sheet. For example, if an asset is listed at a certain value, the auditor should check the invoice or bill to confirm the actual purchase price. Duty to report to the regulatory authorities. The auditor must show the report to those for whom they are responsible, such as shareholders and management, from time to time. Duty to inquire into specific matters. The auditor must inquire into specific matters, including whether loans and advances made by the company are properly secured and accounted for, whether company transactions were prejudicial to the interests of its members. This means checking if daily transactions and purchases benefit the company's members or if they could harm the company in the future. Whether personal expenses are wrongly charged as revenue. This checks if personal purchases, drawings are being incorrectly recorded as company expenses. Duty to avoid conflict of interest. The auditor must communicate normally with everyone, avoid hurting anyone's feelings, and explain mistakes without gossiping. They must ensure there is no discord between themselves, any department, or the internal accountant who prepared the financial statements. Removal of an auditor. An auditor can be removed from office before their term expires only by passing a special resolution. This requires preparing proper documents stating the reason for removal and obtaining approval stamp from the central government or court. Removal is only possible after obtaining this approval. Remuneration of an auditor. The remuneration of an auditor is determined by the shareholders in the annual general meeting. Alternatively, when appointing the first auditor, the board of directors or shareholders decide the remuneration or fee. Remuneration includes audit fee, the fee for performing the auditing. Expenses incurred. This includes transportation expenses, e.g., petrol, expenses for inquiries, or obtaining files from offices or courts, all of which are paid by the company. Other professional charges. Any other charges for work done by the auditor or other persons involved in the auditing process. There is a difference between remuneration and salary, as remuneration includes all things received in return for work. Disqualifications of an auditor. Certain entities or individuals cannot become a statutory auditor. A statutory auditor is one selected according to the law or Companies Act. Body corporate. A corporate entity, like a company, cannot be an auditor because it is an artificial company, not a human being. The exception is a limited liability partnership, LLP. Officer and employee. An officer or employee of the company cannot become a statutory external auditor. Relative or partner of an employee. If a relative or partner is an employee of the company, then their husband, wife, spouse, or any relative cannot become a statutory auditor. Financial interest. Any person with any financial connection to the company cannot become its auditor. This includes individuals who have bought shares or debentures of the company or have given loans or money to the company. Indebtedness, security. If a person is indebted to the company, they are disqualified. Restricted service providing certain services like bookkeeping or internal audit disqualifies a person from being an external auditor. Business relationship. A person with a significant business relationship with the company, such as supplying goods, is disqualified. Fraud or crime. If a person has committed fraud, a crime like smuggling, or has criminal cases against them, they cannot become an auditor. Relative of a director. A relative of a company's director cannot become an auditor. Disqualification under other laws. Even if an individual has the necessary qualifications, e.g., CA, articleship, if there is a complaint against them under other acts like the Industrial Act or Labor Act, leading to disqualification, they will also be disqualified as an auditor.